guys, it's Brenna, the CEO and founder of The Mortgage Shop. I wanted to come to you and explain to you what a DSCR loan is, or what's known as a debt service coverage ratio loan, and the difference between that and conventional financing investment loans. So a DSCR loan is an investment only loan that does not go off your personal debt or personal income. It goes off the property you are purchasing's proposed monthly rental income and the proposed monthly mortgage payment. It usually requires a 1-to-1 ratio or higher. So what does that mean? For example, a 1-to-1 ratio would be if your mortgage payment is $3,000 per month, that monthly rental income that comes back should be $3,000 or higher. And that's projected rental income, guys, off the property you are purchasing. Don't get caught up in thinking it's just the property that you're purchasing. It does look at your comparables in a 3 to 5 mile radius that have sold within the last 6 months to a year. Comparables are anything that compares to your home. So if it's a 2-bed, 2-bath with a view, they're going to be looking at 2 beds, 2 baths with a view within 3 to 5 mile radius to see what compares and get your rental income numbers that way. So with DSCR, it is an investment only loan. You have to have 20% down. Usually you have to have at least a 680 credit score or higher, so a median credit score outside of those 3 bureaus. And it can be closed in an LLC. Conventional loans traditionally do not let you close in an LLC, but you can directly close in an LLC for DSCR loans. I know a lot of you have probably heard that they have prepayment penalties, which is true. Some options for lending do not have prepayment penalties. They're a 30-year amortized loan with no prepayment penalties, which is awesome. But there are also others that do have a prepayment penalty. It could be a 3-year prepayment penalty or a 5-year prepayment penalty. You have a choice to buy down your prepayment penalty if you would like. A prepayment penalty means that you have to pay that many years of interest when you sell or refinance your home. So keep that in mind. They are generally higher interest rates because they're really not qualifying you off of anything that you could qualify on your own, right? They're not qualifying you off of your income or your debt. They are basing this off of that you're going to manage this property really well and be able to produce income by it. And that's what they're lending on. So that's why those rates are a little higher. Conventional investment loans actually do go off of your personal income and personal debt. It's known as a full doc loan. So that is compared to your debt to income ratio. You can use that proposed rental income to help offset that mortgage payment, but it still is going off of your personal credit and personal income and debt. Your credit, guys, for conventional investment, I believe we can go down to 640 for investment only, as opposed to DSCRs usually around 680. You don't have to have any previous experience. Some DSCR lenders require that you have previous experience investing. A lot of them that we have do not require that. So it just depends on what your goal is and what your long-term goal is. So if you can qualify for investment only conventional, which goes off of Fannie and Freddie guidelines, a full doc loan, then I would suggest looking at that first because you will have better rate options. If there's no prepayment penalties on those. But if you are trying to expand as quickly as possible, let's say your debt to income ratio is capped out until you file your next tax return with rental income shown on it, then that DSCR loan would be an option for you. Or if you have more than the max number of finance properties that Fannie and Freddie allow, which is 10, by the way, then you can do a DSCR loan because DSCR loans don't have that max finance property requirement. They are known as a non-QM loan, which means a non-qualified mortgage. So they don't have to follow the rules that qualified mortgages have to follow. That's it, guys. That's the difference. I hope this explains which one would best fit your needs. Like and subscribe to get more information on all other products, and I'll talk to you soon.